So, welcome back to another edition of the Heart to Heart podcast. And my guest today is Nick Maggiulli. So, Nick is the author of Just Keep Buying, and he's also the author of the blog Dollars and Data. So, Nick, welcome to the show.
Thanks for having me on.
So, I really wanted to chat with you today. I've read a few financial books before. I used to say to people before I read your book that The Psychology of Money, which ironically wasn't only written about 2 years ago, is probably my favorite financial book. Read your book, absolutely loved it. And again, that's why I want to have you on. So, why did you write the book in the first place?
I wrote it because actually kind of what was happening with COVID. Like I was like, hey, March 2020 hit. I was in New York City, by the way, for some context. We had this big wave of cases and then the cases kind of dropped down. I was like, oh, look, we flattened the curve. I thought I was like, okay, we did it, right, guys? And then obviously, Memorial Day happened and things opened up again. People started getting it in the rest of the country. And then I was like, oh my gosh, we were wrong. And then that curve came down in like, I don't know, September or October, or whatever. And I was like, okay, now COVID's done. Now we've really flattened the curve. We're done, right? And then in December 2020, we had this huge, whatever the Delta wave or whichever variant it was at that time in December 2020. And then I got super pessimistic. I was like, we're going to be in this thing forever. So I was like, I need to use this time. And I feel like I've written enough material on personal finance and investing at this point that like I need to put together like a higher level philosophy and like a guide for like, how to build wealth. And basically I wrote the book for someone who would just be like starting their career, someone who just, hasn't really done much with their finances yet, but they really want to like figure out what's going to put me on the right path. And so I was like, what book would I have given to like my 23-year-old self? And I even start with the story there and and it expands from there. So that's kind of why I wrote it. I said, hey, I want to create a guide that's going to really get people set up to kind of make the right choices. And even if you're you don't have to be 23, you could be 33. You could have had the first 10 years where you're like, you didn't really have your act together or whatever for whatever reason. And now it's like, hey, I need to do this. This is like the time to do it. So.
Well, I wish your predictions on COVID weren't so accurate, but obviously they have turned out to be very accurate. And I think that bodes well for your book as well, because I think a lot of things in your book are very, very accurate. And I can tell too, like you said, like you wrote for someone who's young, but I could easily see someone, older also benefiting from the book, like the chapter on retirement, for example. That's not something I'm thinking of whatsoever, but I do like how you mention it, like, okay, but what are you going to retire to? Like, that you're retiring from this career, but what are you going to retire to? So I think it's important for people to know that it's not just a book that's written that I think anyways written just for younger people, but definitely for older people as well. And then so I know that you wrote the book during COVID. Obviously during COVID the stock market's been crazy. You talk quite a bit about the index funds in your book and the S&P 500 and things like that. So right now I don't know exactly, but I think in the last 6 months or so, I think the S&P 500 is probably down 20%, something like that. It might be a little bit off there, but I think it's roughly within that range. So I guess a lot of people are thinking now, like, when, Nick, do you think that the market like will bounce back? And do you think that this is like a good time to be investing in some of these, index funds that have not bottomed out, but have, certainly been, lowered overall during COVID?
Yeah, I mean, the thing is, like, there's always a great reason to be buying. There's always a reason to be selling if you really want to, find reasons. You can convince yourself of anything. The fact is, no one knows the future. Like, I don't know if the market's is going to rally up from here, or it's going to be, sideways, or it's going to go down further. Like, no one really knows that. Anyone who tells you is lying. They don't really know. They're just guessing, right? They're making guesswork of the future. And so, obviously, if we're in a 20% drawdown, in theory, that's a better time to buy than like, when we're at all-time highs and things are, screeching higher. But the fact is, like, there's actually no evidence that, buying at a 20% drawdown is actually necessarily better than buying at an all-time high. Like the forward returns are basically the same. The only time when like buying actually increases forward returns is when you're in a very, very big drawdown. So what do I classify that as? any decline that's greater than 40%. That's when there's truly like deals to be had in the US stock market. But if you're down 20%, you're like, oh, well, it can't go down much further. It's like, well, yes, it can. Like, how do you get to a 40% drawdown? You had to be down 20% and then you got to 40. So there's no real, there's no way to know like what's going to happen in the future. So that's why I say just keep buying. Like I buy regardless of what's happening. And obviously, if we're in a case where like markets are down 50%, you're going to probably be worrying about other things more than just your investment portfolio. So that's kind of how I look at it. So for those who are wondering, like, oh, is now a great time to buy? Like, it could be. We could have more pain, though. I don't want you to say yes, and then markets rally up, and then you think I'm a genius. But then if I say no, and markets go down further, or vice versa, like you see, it's one of those things where it's really difficult to know the future. And if I'm being honest, like being intellectually honest, like we don't know what's going to happen next, and so we just got to hope. And so I just think the long term approach to just keep buying over time is the solution to this, because you don't have to worry and spend. Like I don't spend any time like looking at the market. For example, all these people on Twitter talking about, oh, the Fed today raised rates by this amount. It's like I don't watch those things. Of course, that matters. That matters. It affects people's lives, but I don't spend my time obsessing over what the Fed's doing in the specific language they're using in their meeting minutes and stuff like that. It's just not important to me for a long-term investor.
Okay. Yeah, and I like that strategy too for a couple different reasons. I mean, first of all, I think it's easier to kind of follow because like, kind of what you just discussed and what you outline in the book is that you should basically be investing what you can each month instead of trying to like time the market. So don't, save up what you can each month and then every 6 months or every 12 months say like I'm going to buy this like one individual stock. Like that's kind of how you get like burned. And like, yeah, there may be some instances where it works out for someone, but that's not like a good strategy. Like I follow Naval Ravikant quite a bit, and you're probably familiar with him. And like he kind of says like for life and for different things, what you want to do is you want to follow the strategies that are gonna work most of the time. Like he says, like you should be successful in 999 out of 1,000 parallel universes using the strategies that you use. And to me, the strategy that you have with just saving what you can each month and then buying over time, that's going to add up to a strategy that's very, very viable and very, very likely to work. Whereas a lot of people will probably want to save up, and then when they see one particular type of investment that they want to invest in, they'll put all their money into that investment. And then sure, there's going to be blue moon sometimes where it's going to work out for people, but that's not going to be the strategy that's going to work for you. As Naval says, in 999 parallel universes out of 1,000. Like you want to do the strategy that's going to work most consistently. And so I've heard other people, talk about this. There's a guy, John Vallis, who's been on my podcast before. He's a real big Bitcoin guy. And, he kind of says the exact same thing with Bitcoin. Like he says, like, don't try to time the market. You'll get burned. Like put it in what you can each month. Bitcoin's a whole other story, but it seems like, whoever I talk to that's in the financial field, that seems to be the strategy that they think is, most beneficial. And so, I know that there's chapters outlined in the book that go through this in detail, but, if you can, like, how did you come up like with that strategy, and like, why do you think that it is, the best strategy for long-term financial success?
Yeah, so I didn't come up with this strategy at all. This strategy is something that came from Benjamin Graham, in like securities analysis, an intelligent investor. Some of your listeners may know that, but Benjamin Graham, who was Warren Buffett's mentor, basically, I think he popularized the term dollar cost averaging, which is buying over time and just investing into the markets over time. And so I didn't come up with that. I just came up with a better, I think just keep buying is a better slogan than dollar cost averaging, if we're being honest. So I've rebranded it a little, but more importantly, I brought a lot of data and I said, I analyzed these different approaches and these different things that people do. Like, oh, you should save up cash to buy the dip, right? You're going to, next time there's a dip, you buy that dip and you make more money. And I've shown, definitively, I think in the book that that's not true. Right. And so I think the only thing I've done is I've really just brought a lot of evidence, brought a lot of evidence to the table to say, hey, is this actually true? Yes, it is. Or, hey, is this true? No, it's not. Right. And so I discuss a lot of different things in the book, certain things which I think are myths and whatnot. And I kind of tackle those things and just discuss them in ways where, because I haven't been in the financial industry that long. Like, that's what's so weird. I've only been in the financial industry 4 years. And I wrote this book, obviously, only being in the financial industry for 3 years. You're saying, well, why should I listen to you? You don't know anything. It's like, because I'm not putting my opinions out there. Like, I'm just finding the data and the evidence and I'm just presenting it. I'm saying, hey, here's what people say. Here's what the evidence says. Like, does it make sense? And sometimes they're spot on. Like, for example, when you ask most financial advisors, when you're saving up for a home, how should you save that money? Should you have it in cash? Should you have it in like bonds, stocks, mixed portfolio, whatever? And basically across the board, advisors said you have to put it in cash, right? And I was like, okay, well, let's see if that's actually true. I looked through it and it's like, yeah, cash is probably the right thing. Given the risk profile and everything, you're going to be buying a home in the next 2 years. You got to just hold that in cash. And you're like, well, Nick, inflation. Like, yeah, inflation sucks, but inflation's bad. But, this year bonds are down, what, 20% depending on the duration of your bond,
That's a lot.
how, if it's longer duration or not, but bonds are down badly. So imagine you've been saving for your house in 2021, you have it all in bonds. And now this year happens, you now have to save probably an extra 6 months or so to get to your down payment versus, your cash. Yes, your cash would be down from inflation, but in theory, like the cash is not down like in nominal terms, like the bonds are down and there's inflation. So bonds are double whammied, right? So it's really rough right now. So that's what I'm saying. Like there are certain cases where like advisors said, most of the advisors I spoke to said hold cash and the data shows that. Then there are other cases where like I may, someone make an argument about like, oh, you should max out your 401k. And I show it. I'm like, oh, I'm not necessarily sure. And I can explain why that's maybe not be the best move for everybody.
Yeah, I definitely like that chapter a lot because I do think that flexibility is really, really important. And because again, like the market's very, very like volatile. And also too, as you point out in the book, life is volatile too. Like you never know when you're going to have like an unexpected expense. And you never know too when there may be, a great opportunity to buy when the market does go down by, like you said, like 40%. And again, we're not saying that's like a hard number, but it is a good gauge overall, to buy when the whole market is down by that much. So I think that it's important to kind of keep that in mind. But one thing that I really wanted to ask you about, Nick, too, was cryptocurrencies. I think that was one thing that I didn't see too much of in your book, but I just wanted to I was very curious what your thoughts are on that, because like I said, there's a lot of good advice in the book, and a lot of people right now are wondering about cryptocurrencies, and I'm just wondering what your thought is on that.
Yeah, so the reason I didn't talk a lot about cryptocurrencies is because I don't consider it a quote income producing asset. Like an income producing asset would be something like, ownership of a business, aka a stock, real estate, bonds, farmland, there's other types, royalties. If you have royalties, you can buy royalties, things like that. Those are all income producing assets, rental properties, right? I say, the bulk of your assets, 85, 90% should be an income producing assets. And the other 10%, I think if you want to, can be a non-income producing assets, right? And what does that include? Gold, art, wine, crypto, et cetera, right? All those things I put into another 10%. So I didn't really cover those in depth because I don't think they're a major part of an investor's portfolio. And I don't think they're the way to build wealth in the long run. Now, of course, there are going to be people like, well, Nick, I got rich in crypto. Yeah, it's like there are some people that got rich in crypto and there's some people that went broke, that bought Luna at the top, or bought, Bitcoin at $68,000 and aren't necessarily rich anymore, mortgage their house. Like, so there's both sides of that. So you can't just say, hey, well, there's some people that built their wealth using this, therefore we should all build our wealth using that. Like, no, there's like also lottery winners, right? I mean, do you want to say like, oh, you should buy lottery tickets as a part of your allocation? Like, I think, you see that's the exact same type of argument. So my thoughts on crypto are, I think it's an interesting asset class. I do think it's kind of like a digital gold, if I were to see it that way, like a Bitcoin specifically. I have no idea what's going to happen to the future of it. So my approach has been very straightforward and naive, if I'm being honest. And what I say is I hold 2% crypto and that's it. And I rebalance periodically. So I had 2% crypto at one point when Bitcoin was like 8,000. It got up to like 52, right in like February 2021, I think it got to like 52,000. I sold half of my Bitcoin just because I was rebalancing. I had no idea what the future of the coin was going to do. It then proceeded to go up, down, up. It jumped a lot around a ton. And then obviously it's since crashed, right, a bit. So I got lucky there, I'm going to be honest, but I also wasn't trying to like time the market. I was just doing a standard rebalancing because it went from a couple percentage of my points in my portfolio to a very significant amount. And I said, hey, I'm keeping it 2% and that's it. And so Right now, it's actually back at around 2%. But if Bitcoin were to drop more, let's say it got cut in half, I would be adding to it. I would be adding more Bitcoin to my portfolio. So I think that's the standard approach. And where did that 2% number come from? Basically, there's something called optimal portfolio theory, where you put in a bunch of, it's a basically a big math equation where you solve all this stuff. A computer does it. I can't do it. I would just sit and it would take me like probably like a week to honestly do all the math for this crap, right? So it basically just says, what is, if you give me all the asset classes, stocks, bonds, crypto, etc., and you give me their historical returns, it'll find the highest return portfolio per unit of risk. So like, what would have been the optimal portfolio to own over the last N years, considering the amount of risk involved? And so when I ran that simulation, the number it came out with, remember this was long from like 2010 to like the end of 2019, it was like 45% US bond, like 53% US stock, and 2% Bitcoin. So that was the answer. Now I don't own, that's not my portfolio. I don't have, 45% US stock, 43% US bond, or whatever, 53% US bond, whatever it was. I don't have that portfolio, but I'm just saying, I thought the Bitcoin point was interesting, because just having a little bit of Bitcoin in there adds very little risk to your portfolio, but it can add a ton of return in the event it goes up a lot, right? So I think because of that, like, that's why I was like, hey, like, there's something here. I don't know what it is. I have no clue the future price. I'm going to act naive in this sense, and I'm just going to own 2% of my portfolio. And I've done that, and it's worked out for me so far. I have no idea what's going to happen going forward, but I plan to keep 2% until I think the fundamentals of owning it have completely deteriorated, if that ever happens.
Okay. Well, thanks for the detailed answer on that. 2% is yeah, I mean, it's not, nothing, but it is something. Like some people may say that's not very much, but 2% is something. And over time that can definitely accumulate. And I like to, like you said initially, that don't put more than 10 to 15% in non-income producing assets. So if you are someone who's like, really, really bullish on Bitcoin, and you want to go all in without going all in, so to speak, what you could possibly do, kind of thinking with your strategies, is that you can maybe say, okay, well, for all of my non-income producing assets, I'm just going to do all Bitcoin. So you could do 10 to 15%, and that way you could still feel like you're bullish on Bitcoin, and like if you really believe that that's what's going to be be the answer for you, you could go ahead and do that. But then going beyond 10 to 15% just doesn't really seem to be like a good strategy. Like then it kind of just seems to be more like you're taking a complete risk, and like you're kind of gambling. So I think I think that was a really good answer overall. One thing too that I wanted to ask you about, another thing that I didn't see too much of in the book, but a lot of people now are into investing into IPOs. They think that, if they put money in before, a certain company goes public, that's going to be their ticket to success, or their ticket to, get rich, so to speak. And for people who are listening, what we're talking about is initial public offering, where you put money in, say at 5 cents or 10 cents, whatever the offering is. And then eventually down the road, it could be months, could be a couple of years, that that company then goes public on the exchange, whatever exchange it is. And then, it may open at $1, it may open at 5 cents, whatever you put it in, and it may even open lower. So, what do you think of those kinds of investments? And is that something that you encourage others to do, or is that something that maybe you would include in that 10 to 15% that you're talking about, and would just do maybe, a little bit of?
Yeah, so with IPOs, it's very interesting, because I think the IPO market has changed a lot historically. I mean, you have to realize, back in the day, like when companies went public, like they went public when they were relatively small. Like they weren't necessarily these multi-billion-dollar corporations every time they went public, right? And so I think what's happened, because VC is so involved now with companies, like companies are raising so much money, they're getting to the point where like they're getting funding. Before, how would you get funding? You would go public, right? But now they're getting so much funding earlier, they can wait and wait and wait to go public until later, right? And so because of that, I think some of that alpha is being taken away from investors that could have gotten it through a public market offering. That's one piece of it. The second thing is, like, they've actually done analyses on IPOs, like from history as well, and they find like there's no relative advantage to getting into IPOs. Sometimes they'll work out really well, and sometimes they don't, right? If you like bought Amazon's IPO, you would be absolutely crushing it, right? But if you had bought Facebook's IPO, even, this is crazy, you're saying Facebook, I mean, Facebook's a super successful company. If you had bought Facebook's IPO to date, and this is as of this recording, whatever, so early November, 2022. If you had bought you would have been better off if you had bought the S&P 500 instead. If you just literally, so if you had 10 grand and I say you can own Facebook or you can own the S&P 500, you would say, no way, Facebook's a huge company. Nope. You would have done better off if you had bought the S&P 500 way back in whatever, 2012, whenever it IPO'd. Yeah. That's how down Facebook is right now. If people don't realize how down Facebook is now like remember, it's relative to the S&P 500. Facebook's obviously above its IPO price, but the S&P 500 has grown as well. Right. And so that's the difference. It's like to date, like on a total return basis, the S&P 500 has outperformed Facebook since its IPO, which is absolutely shocking, right? And so if you really think about that, that says like even a successful company can go through a bad period where, even since IPO. Now, of course, if you had sold Facebook 6, 8, 10 months ago, that's a very different story. You would have made a far more money, or even a year ago, you'd have made far more money, right? But the problem is like Facebook is down, it's going through a tough time right now. And so because of that, like you can see even I told you successful IPO. The question is, well, what do you do with it? When do you sell it? Because let's say you made a bunch of money on Facebook, you may never want to sell that thing. And then next thing you know, now you're down 70 something percent. And you're like, holy crap, I could have just, bought the S&P 500 and it would have been better off, So,
That's insane stat.
yep.
When did you discover that?
Oh, I didn't discover it.
Okay.
Ben Carlson, who a colleague of mine discovered and tweeted about it. I actually discovered independently of him. I discovered that you put like $1,000 a month into Facebook since its IPO, and then you put $1,000 into the S&P 500. The S&P 500 would have done better over that time period, right? If you just put $1,000 a month, right? Yeah, since like basically the IPO.
Okay.
Yeah, so it would have been done better if you put like, and that's on accumulation, right? Because most people don't just put a bunch of money once; they're usually investing over time, right? So I said, let's actually do that, and then I found out, oh my gosh, even on a total return basis since the IPO, the S&P 500 has outperformed, I was shocked by that. I was like, wow, this is because that's how Facebook's down right now. Like, I don't think people realize like it is down quite badly.
Wow, that's just a crazy statistic. Like to hear, like if someone said to me, you had a chance 12 years ago to invest into Facebook every month or S&P 500 every month, I wouldn't have even I would have started laughing and just been like, obviously Facebook, this is a joke, but I guess not, which is interesting. And it also shows just how strong like index funds can be, and why like it's a very, very good strategy, and where maybe you should put quite a bit of your money. And I noticed too, like you had a chapter in your book too about not buying individual stocks, and I guess that kind of like ties into what we just talked about, because essentially buying into an IPO, you're buying into one stock, into one company. And so you mentioned in the book how if you and again, I don't have all the statistics here in front of me, but I do have the book here, so this is it here, guys. And
Thank
you
you.
can see it in Nick's background.
Yeah, I'm also these are different versions. I promise I'm not a psychopath. These are different, like one's an Indian version, one's like, the hardcover, one's a paperback. Yeah, no, I have a bunch of different versions. I'm gonna have more. I'll have one, the Korean one's getting shipped to me. I'm putting that one up there. There's one in Indonesia I'm gonna put up there. Eventually I'll have a whole shrine of different versions of the book. So
that's awesome. That's awesome. Well, yeah, I'm glad that it's been so successful and it's getting translated into different languages. But yeah, like just coming back to the IPO thing, I just thought that kind of tied in nice, because you did have a chapter in there about not buying individual stocks, and it kind of seems the same thing as with an IPO. Like it's something that you may want to do, like you said, in that 10 to 15% of your non-income producing assets, but over time, putting that money into an index fund seems to be significantly less volatile, and it ultimately can produce the same results over time. So I think that's something that a lot of people would definitely benefit from, because there are people who do put quite a bit of money just into one stock, thinking that that is going to be ultimately their ticket.
Yeah, and for some people it is. The question though is, imagine you get into one of these scenarios where, obviously I'm not going to say every person that's ever bought a stock and it's went up a ton's all luck. I'm not saying that, but obviously it's hard to know the future, right? Like I would say if you had asked me, 10 years ago, Facebook was not, when it first IPO'd, everyone's like, oh, this thing kind of sucked. And so that's why it dropped right after the IPO. If you remember, it dipped down, I don't know, I think 30, 40%, something like that. But then they got the mobile ads working and started making a ton of money on ads. And then all of a sudden this thing just took off. And then I had friends leave to go to Facebook. Next thing you know, I have friends that are multimillionaires from this because they sold their stock, obviously, right? But it's just like people that have made a ton of money just and they got lucky, they got on this thing. And so it's like it happens. That type of stuff happens where, businesses can turn around, but that's not always the case. And so that's the thing to remember. The other thing about investing in an index, you probably said, well, look at the index for the last 10 years. The index 10 years ago wasn't the same as the index today. That's the beauty of the index. Like things are coming in and out of the index as businesses kind of deteriorate, they get removed. And as new businesses, grow, they get added, right? So for example, Tesla wasn't in the index, until like a couple of years ago, right? But that's an example of something where like a big company was not in the index, it got added. And then there's other companies that used to be big that started to fall off and they get dropped out. And so this natural progression, you're owning kind of the basket. And so you're owning the things that tend to grow. And of course, there's going to be some things that fall and some things that grow a ton, but those kind of balance out. And on average, you get the market return, so to speak. And that's where you make your money because you don't have to manually select, oh, do I want these stocks and not those? I mean, the half-life of a public company, there's a book called Scale where this guy Joffrey West, I think his name, basically he found the half-life of a company is 10 years. So take all the public companies, within 10 years half of them should be gone. And what I mean by gone, bankruptcy, acquired, mergers, things like that, roughly half are taken out within a decade. So that's the thing that, so like I don't think that's true the S&P 500 because they're bigger, a little bit more established companies, but like at least I would guess 20% of the companies that are 20 maybe 30% of the companies that were in the S&P 500 10 years ago aren't in there now for one reason or another, right? Because new ones got added, old ones that kind of started to fall off got dropped out, etc. So it's that renewal, it's that kind of creative destruction thing that's happening over time that really allows us to benefit from that as index investors.
That's a really important point. I actually didn't know that they, continuously add and drop companies. So essentially, it's really like a financial advisor almost for you. Like it's not like you're investing in, these 500 companies and then that's it. It's like you're investing in, the best performing 500 companies at the time with change over time. So like, based upon that, you should kind of feel more comfortable doing it because it's not just investing in 500 companies again that are just still it's the 500 ones that are best producing at the time. So I can imagine that would make a lot of people more comfortable into investing in them. It certainly would make me more comfortable knowing that they are going to change whether a company performs or doesn't perform. And then there was one other chapter that I really like, Nick. You talked a little bit about, savings versus your income. And overall, you kind of mentioned that at some point it's impossible to save more. And then it's just better to, earn more income. And, some people may find that, a little bit difficult to hear. And sometimes for certain people in certain jobs where they can't get, more hours, it may be difficult for them to, employ that strategy. But at the same time, there does come to a point where you can't reduce, the cost of your living anymore. And then I also think too that it also puts you into a little bit of like a scarcity type of mindset when you like start to live that way. When you start to just reduce and obviously there's a lot of benefits to reducing, and I'm a fan of minimalism in a lot of different ways. But at some point it is going to be easier to increase your income versus say just try to keep reducing. So what was the purpose of you writing that chapter, and what kind of like inspired you to do it?
Yeah, I think the cutting spending versus raising income debate. I mean, because if you think about how do you save more money, those are the only two options you have, right? It's like you either cut your spending from whatever level you're at and you take the excess and you save it, right? Or you raise your income without changing your spending, obviously, and then save that excess. Those are the only two ways you can do it, right? And I think there's like two factions out there. There's the raise income people and the cutting spending people. And I said, well, which one's right? Let's dig into the data. And I think for the most part, like the raise income people are correct because you can cut spending to save money. And of course, everyone listening to this is going to know that one person who's like, this person spends money like it's going out of style. And so that's not true because that person, like, yes, I understand there are people that are spending too much. That's obvious. That's clear, right? The problem is in the data, though, on aggregate across the entire country, across every person. If you actually look at the data, the thing that's most correlated with savings rate, the percentage of your income that you save, is income. It's a higher income. So people with higher incomes have higher savings rates. That's the key. It's not like, oh, well, what about their spending? Like, no, it's all about your income. It's the most correlated thing in the data, and it's true across time. They've looked, going back to even like the 1930s, they found that's the only time where the rich actually saved less than the poor was during the 1930s because of the Great Depression. But outside of that, like every other period, like higher income people, it's easier to save more. And the reason is very simple, right? Like I call it the law of the stomach. You can only eat so much, you can only consume so much, right? It's not like, oh, if I get 10 times richer, I'm going to eat 10 times more, spend 10 times more on food. I might spend a little more on food, probably even getting higher quality. Let's say you go from standard eggs to cage free eggs, whatever. You can make all those little, marginal upgrades, and it's not going to add up to 10 times more necessarily, unless I get like a private chef or something. But how many people do that, right? You see what I'm getting at? Like most people
Yeah.
don't need all these spending upgrades as their income goes up. So it's very logical why. But I agree, it is harder. Like the best thing you can do to save money in the short run is cut your spending. If you need money now, you have to cut your spending. It's the only way. But over the long haul, you're right. It is a scarcity mindset. It gets you into different modes of thinking that I personally don't like. And so I encourage people, okay, maybe you can't do it at your job, like you said, you're 9 to 5. And I think 9 to 5 is a great way to do that. I'm not against the 9 to 5 in the corporate, climbing the corporate ladder. Like I trust me, I do that. Like that's like my main job. I have a job where I work, 40 hours a week and all that. So I do that, but I also have this side thing I do as well. And so I think you can find a side thing if that's necessary, or you can just go all in on your job. There's a bunch of different ways. I technically encourage people to do a little bit more, just have different income streams, but
Yeah.
everyone, it's to each their own, right? It depends what you're trying to do, right? So that's my thing. So
I-
yeah, I would say
And
just
and
focus on raising income.
and I think on that note too, like, especially if you're young, but even if you're not, like if you have free time, like don't waste it. Like try and find like a side hustle to do something, because even if you have like a 9 to 5 job, like yeah, that's going to eat up a lot of your day. But there's a couple hours in the morning that you could work, there's a couple hours after work that you can work, and over time you can do quite a bit. And I mean, for myself, this podcast, for example, like it's not part of my 9 to 5 job. I do this outside of my job.
Mm-hmm.
And sometimes it's a little bit difficult because I have to do quite a few things to try to get guests and write about the podcast after, make videos, things like that. It's a little bit time
Mm-hmm.
consuming, but overall in the long run it can pay off. And I think that for a lot of people, if they like don't feel like your only source of income can be during 9 to 5, like there are other ways to get income. And you do have to, it sounds very basic, but you do have to work hard outside of those hours. Like you can't just rely on 9 to 5 if you want to generate generally a second type or a passive type of income. And I know that's certainly challenging, especially if you're older and you already have kids and they take up a lot of your time. But I think that eventually, if you just keep putting in the time, time compounds, and over time you can build yourself a business or build yourself a brand or write a book like you've done, where you can sell something and you can have that type of passive income. And you never know where your book can lead you. Like your book could lead to another book. Maybe someone will want to will offer you a crazy deal for another book. So it's something that you just kind of have to like take a little bit of a risk on. And also too, you have to understand that generally speaking, in the side hustle, not all the time, you may not be generating income at the beginning right away, but that's what kind of everybody goes through, I think, when they are trying to generate that second kind of income. So I know that you did it during the pandemic, but did you feel like you were like time constrained to like write your book, or did you feel that even with working the job that you have, it was something that was something that you thought was like feasible from the beginning to be able to complete?
Yeah, so I wrote it basically on the weekends because obviously my job, I just didn't have time to do it, if I'm being honest. So yeah, I basically took every weekend. Remember, it was 2021, so we were all back inside again really early, at least in New York City. We were back inside, like no one was going out, people were scared of COVID. So I was like, I need to use this time. So I took every single weekend for the first 5.5 months of the year, and I just wrote like all day Saturday, all day Sunday. And I still kept up my blog. So I remember I'm blogging once a week. So I either wrote for the blog and like the other time on the book, and just wrote and wrote and wrote and wrote. And so that's all I did, and got it first manuscript done mid-May. We got edits by like July, and then went through that, took, another bunch of rounds of edits, and we got those kind of done by like end of July. And then we sent it to the printer in October. So most of it was done by end of July. So
Yeah. So, I mean, yeah, that's essentially, what it takes is that you're going to have to spend your evenings and weekends, doing something. But I think that for you, obviously, you're very, very passionate about doing this. And, not everybody likes their 9 to 5 job, but the thing that you do afterwards, that should be something that I think that you should be passionate about. You're not going to want to do it. Like if you're doing it, purely for the money or purely for the second income, it's probably not going to be something that you can do for a long time, because you can't really do anything for a long time that you absolutely hate. But if it's something that that you really enjoy doing, you can kind of do it for a long time without, not saying that it's still not going to take a ton of effort, but it is something that you do have to feel passionate about. And I guess for you, like, it was probably a no-brainer. Like, you seem like you're very passionate about finance, like a lot about it. So is that how you kind of came to the conclusion that you're going to do the book? Or
yeah, I mean, I said, hey, I have an opportunity, which is this. Sometimes, life offers you opportunities. That I have this opportunity of like, I'm trapped inside basically again, and I didn't use it last time, because when I got trapped inside the first time, in March 2020 and all that, like I was like, oh, this will be over soon. I just kept believing this is gonna be over soon, it's be over soon, it's be over soon. And then when it wasn't, I was like, we're gonna be trapped in forever, so I need to like use this time. So I said, hey, I feel like I have enough work out there. I've been writing for 4 years at that point, I guess. Yeah, I've been it was early 2021. So I've been writing for 4 full years. So I'm like, hey, I think I have enough material now. I've been trying to put my message out there. I think I need to get into a book form. And the reason for that is like, a lot of people don't read blogs, right? I'm guessing most people, even on, in your audience, most podcasts, don't spend time reading a bunch of blogs. Maybe there's one they follow, if that, right? And so most people don't read blogs. So like, my potential reach was so small relative to what I thought, the value I could bring. So I said, you know what? If I put in a book, at least I'll get the book readers. Cause like, honestly, before I was blogging, I didn't read blogs. I only read books. So I would have found this in one way or another. I would have found
yeah.
this, but I wouldn't be able to find my blogs. I'm like, how do I reach myself? How do I find the me's out there that never have read blogs? And so I pushed that information to them. So that's what I did. So that's kind of the goal, just to expand my audience. That's why some of the work in there, if you've been reading me for years, you'll recognize like, 50% of the stuff in the book is maybe stuff you've seen before. It's always been cleaned up and it's much better now, but that's kind of, the whole premise of what we did.
Okay. And one chapter I think that's really, really important, because as you say in the book, it's one of the most important financial decisions that you'll make is buying a home. But and I know that there's a lot of people into kind of like flipping homes right now, but I was a little bit maybe surprised that, and I forget the exact figure, maybe you can remind me, that how many years does it take for you to get back what you would have put down on the home in terms of like real estate fees and that kind of thing? Because you were saying that if you're not going to be in your home, I think it was for either 5 years or 10 years, that like it's
10.
almost better 10. Yeah, like that's quite a long time. Like a lot of people think that if you're going to be somewhere even for 2 or 3 years, that you should buy your home. But you're saying that like basically with like the real estate fees and that kind of thing, that you probably shouldn't do it unless you're going to be there for like 10 years. That's it's
Yeah,
quite a
so
bit
I
of
think
time.
the reason I made that argument, here's how I got to where to get the 10 years from. The typical, I said there's a lot of different ways in which fees can come in depending on, do you have a seller agent, a buyer agent, all these can add up in different ways. But let's just say the average fee was about 6%. That's all in, like everything, closing costs, everything in the real estate, you pay the real estate agent, all these things, right? It's 6% of the home's price, let's say, is what you have to pay. Okay. So if it's 6%, and we know from the data, there's data from Robert Shiller, a Nobel Prize winning economist. He's really analyzed real estate data every way. Most of the real estate data, shows that U.S. home prices have gone up by 0.6% per year after inflation. There's a real return. So that means 0.6% per year. That's what you expect to get, all else equal, times 10. That's 6%. That's how you get there. Of course, you're like, well, Nick, since 2000, prices have done this or that. Yeah, change the number then. If you expect to get a 5% return per year in your value, okay, then you only need to be there, you're right, 1 year, right? But it's hard to know where prices are going to go, and to try and keep predicting price and saying, oh, they always go up, they always keep going up. Like, yes, over the very long run, they should go up, but if they get bid up too quickly, they can fall. You saw what happened in 08, where there are people who went, I had family members underwater on their homes, and where it's like, wait, why am I paying this mortgage when my property is valued at like, $100,000 less than this? Is crazy. I should just lose the home. I don't want the mortgage. I don't want to pay it. So it's a weird thing like that. But the end of the day, like, I'm trying to do this best I can with the data we have. Of course, maybe the regimes have changed. Maybe homes will go up by 2% a year. Okay, then you're right. 3 years would work, right? I don't know. And so I'm just telling people to be cautious. I'm trying to use the data that we have, and the best data we have says, 0.6% a year after inflation. That is the real return on U.S. real estate over the long. Remember, there's over 100 years of data on this, right? And there's times, and it jumps around a ton, right? There's times when it's down bad, and then it comes back, and then it goes up. It jumps around. So there's so much volatility, to be honest with you. That's why I was like, 10 years is conservative. I think it's probably a fair estimate, right? Because there's a lot of things that go into owning a home, and this doesn't even include like, okay, the maintenance you have to put into a home too. That's going to obviously happen, but I've even ignored that completely. And just assuming you're trying to flip over a 10-year period, that's the price.
Okay. That's a good, hard number for people to know, 10 years, because there are a lot of people, I think, and, myself really included, that thought that it would be significantly, less. I thought it was going to be maybe like 2 or 3 years, so very important chapter that you wrote. And so I'm really glad that we chatted about that today. And then, maybe the most important chapter in the book is the first one. It's called Saving is for the Poor, Investing is for the Rich. So, essentially, I know that you said that if you're saving for something specific, it is good to, save in cash for that specific thing. But your overall strategy in terms of like where you put your income should not be just to save and put it in a bank account. It should be to, save it and then put it into something where you can actually get more return for it. And so, why do you think some people are, kind of hell bent on, just saving and not investing, versus other people who, feel that, if they did something with their money, if they did invest it, it would, give them a better return overall? Like, what's sort of the mindset there, and what's something that maybe, a piece of data or something that you could say that might change their mind?
Yeah, so I think the biggest mindset shift, one, it's going to be knowledge. Like, some people just don't know. They just think, oh, you mean saving money? I just put it in my bank account, right? It's like, that's one thing. People may not know about investments. They may not know about, stocks or index funds, things like that. That's one piece of it. The other piece of it is probably a little bit of fear, if I had to guess. Like, oh, there's people out there that think the stock market is a literal scam. They think it's like a Ponzi scheme, like everything else. And of course, there are some arguments within that are like, oh, but what is it made of? It's like, it's value based on what we value it. Like, yes, that's true. It's value based on what we value it. Just like, but that's how most prices of anything works. Like, when you go to the store and you're like, this Coca-Cola is not $1. It's like, well, it's $1 because that's what price and demand. If people valued it more, Coke would raise the price more. If people valued it less, they would either lower the price or they would just go out of business, right? So
Yeah.
prices are prices, right? And so to say like, oh, the stock market's a scam when the Fed changed an interest rate and then my stocks go down, like, how does that make sense? It's like, because people are valuing these things based on changing information. That's what's happening. And so it's not a scam, and like a true Ponzi scheme is like, you're putting money in, and the only way you make money is if that person gets more people to put money in the future so they can pay you out. Like, that's the only way you, quote, make money. And they have to keep getting an increasing amounts of money put into the system, or else it all collapses, right? In the case of, finance and capitalism, like, yes, people are investing and money's coming in, but there are times when money goes down and then prices go down, right? Things just equilibrate. It's not like everyone, the whole thing implodes on itself. That doesn't happen in the same way, right? So that's where it's a little bit different. So that's what I would say. It's like, there's some fear there, and then there's also like, people just don't know. And so like, what data points would I put out there? Like, the stock market, I mean, it doesn't have to be the stock market. You can own real estate. There's just so many people, like, most of the people that have, gotten wealthy in this country, besides people who own businesses, obviously that's a big portion of it too. Like, the absolute richest people usually own their own companies, like the Elon Musks of the world, etc. But people just like the typical affluent person, who has, high net worth, million plus, they own stocks, they own real estate, they own bonds, they own those things and they bought them and held them for a long time. That's like the most typical way. They had usually a pretty decent income and they saved in those assets. They saved and invested in those assets and just waited and let the market and everything do it for them. And so stay diversified, own income producing assets. That's the key. That's the way. If you're not going to have a super high income, you're not going to own your own company that goes public and makes you super rich. If you're not going to do those two things, you have to get into income producing assets. That's the only other way.
And I think you mentioned in there, Nick, that I was, I mean, I shouldn't have been shocked at this, but it was just such a high number. I think you said that close to 90% of the millionaires in the United States are did it from real estate. Was that accurate?
I have no clue. I didn't put that in the book. You may have heard
Okay.
that somewhere else,
Maybe,
but like,
maybe
there's a lot of
read
people. I
that
mean,
somewhere else.
it depends like how you define, is every millionaire, what do you mean did it from real estate? Like most people, most rich people own their own homes. And so if their homes appreciate at all, does that mean like, how do you like, for example, let's say I had a stock portfolio and I owned a home, right? And let's say they both went up the same amount, right? Technically, like this home is one of the reasons why I became a millionaire, but so is the stock portfolio, right? So it's like, how do you, if you're attributing all of that to real estate, I don't think that's accurate.
Okay.
Trust me, I'm not anti real estate at all, but I'm just like, I think people over focus. Oh, you can't, the stock market's a scam. Real estate's the only real thing out there. And I just don't think that's right at all. I mean, there's so many people that are rich off stocks. It's ridiculous. So to just look and say, oh, it's only real estate or only stocks, those are both wrong. There's so many ways. There's a lot of ways to get rich, right? And so I think that's the real truth of the matter. And there's people that are going to sell you on thing because they have an interest. Like if I'm a real estate guru, I have a vested interest in telling you to get real estate and buy my course and do my thing and do this, right? Because like it's going to make me money, right? Just like if I'm a stock trader, I'm a trader course. But guess what? Nick Maggiulli, is neither of those. Like I say, you can get rich in both, and it's a question of if you do it the right way, right? And so I'm trying to be very open and honest about this, and I have nothing to sell you. Obviously, I have the book to sell you, but that I don't have anything specific within stocks or specific within bonds or real estate or any of that stuff to sell you, right? Like I'm not trying to peddle some like trading system to get rich. Like this takes a long time. It's fundamentals. You just got to save money for your income, your job. That's it. And you invest it. And over the long haul, historically it would have worked. It would have worked over so many periods. Diversified portfolio would have gotten you rich. The question is like, will it work in the future? I think it will. If it doesn't, we have much bigger problems in our investment portfolios. We have like, growth issues. We could have, war. Who knows? If it doesn't work, it's going to be because something really bad is happening with humanity, in my opinion. And I think in that case, who cares about your investment portfolio? It's probably like a world war going on or something.
Okay. Yeah, I think that's definitely good sound advice. And then with regards to what you just said, I remember you did tweet out something a couple of weeks ago. I think I retweeted it about someone selling a course online. And like a lot of people I think do jump in and buy these courses thinking that it is the kind of like get rich thing to do. Are there any courses that you do think are worthwhile getting, or do you think that for the most part, those kind of courses or those kind of things that people put out you're probably not going to get the return on your money for?
Okay, I don't want to like I don't
Yeah,
consume a ton of courses, so I don't want to
I
say, oh,
know.
all courses are bad. Like I have no clue.
Yeah.
I really have no real comment on that in particular. In the
Okay.
particular tweet I talked about, there were so many people like, oh, I make 6 figures a year on Twitter. And how do they make their money? They sell courses on how to grow on Twitter. It's like kind of it's like a reflexive problem. It's like the snake eating its own tail. It's like, wait, what? It's like chicken and the egg problem. It's like, so wait, you got rich on Twitter by telling other people how to get rich on Twitter, right? It's like a weird, like what? Like it makes no sense. Like it's not like you got rich on Twitter by like selling your product or something, right? It's like you got rich by selling courses on telling other people how to get rich on Twitter. It's like almost like it's a mental Ponzi scheme if you think about it, right? It's like
Yeah.
you didn't actually create any value. You're just selling other people on the idea of creating value. And the only way they're going to make money is if they end up selling other people on the idea. It's like a weird, like, I don't know a single person. I'm not saying that there aren't people, but I never rarely see one of those like, hey, I'm making like 5 figures a month on Twitter. And they're not selling a course about like growing your followers or Twitter specifically. Like it's always, very few people are like, oh, I'm selling these products and here are the products I do. And the products have nothing to do with Twitter. They're just like products that I think are good and useful. Right. And so, I know people that like, for example, Visualize Value, what's his name, Jack, he does amazing stuff, and so he's actually really good at that, but he's actually creating a whole brand there, right? And so I think that's like something where like he's creating a brand, he's selling something specific, he's not trying to sell you Twitter courses. So that's an example of someone who's doing it, I think the right way and the genuine way versus people who are just like trying to sell Twitter courses, so
Yeah.
anyways, rant over.
No, that's really important because there are a lot of people. I mean, there are a lot of people out there who are selling something that has genuine, real value, but there are a lot of people
Mhm.
who are just selling something to sell to other people, hoping that they can actually sell what they've just sold to them. It's like people are just like recycling each other's bullshit, you know? And I think that there's a lot of that like going on, and people, you know, somehow buy into it. And but I don't think that it's, you know, it's feasible. I don't think it's a good long-term strategy, and I don't think, you know, it's good morally to like sell something that doesn't provide, you know, people with any value. Like, you know, your book is, you know, almost 300 pages, and you know, I probably paid 20 or $30 for it. Like, it's, you know, an incredible return on investment for, you know, 20 or $30, where there's people who are selling like $300 or $1,000 courses, and you know, they're essentially, you know, not giving or providing any value or giving you anything of substance. And before I let you go, Nick, I know we don't have too much time here left. You know, maybe this was actually the most important chapter. It said time is your most important asset. And you know, I think you brought up in the book the example of, you know, would you trade, you know, yourself, your life, or, you know, Warren Buffett's life and money right now? And you know, when you think about that, most people would be like, you know, absolutely not. Like, I'm not sure how old Warren is exactly, but you know,
I
I'm
think he's
38.
92 now. Yeah,
He's
he's 92
92.
now. Yeah.
Holy shit. Yeah. So, you know, there's nothing, I'm only 38. So there's no way I would, you know, give up all those years just to have, you know, that kind of, you know, wealth. So obviously, you know, when you think about it that way and you look at the big picture, you know, time is your most important asset. And, you know, you should look at it like that. Whereas, you know, a lot of people will, you know, think that if they sacrifice, you know, time for money, it's a good thing. And obviously there's going to be some sacrifice in your life. You can't, you know, just create value out of nothing. You have to put the work and the time in at some point. But I do think that, you know, it is good to try and you know, like you said, you know, invest in the things that are income producing assets, so that you're not eating away more of your time. So like when you start your second hustle or your side hustle, you know, it should be something that hopefully you'll be able to do with more free time. You know, you don't want to start something where, you know, well, now you have to work you know, twice as hard for the rest of your life just to, you know, keep up what you have. What you want to do is you want to create something of value, so that you can create more time for yourself, so that you can use, you know, that kind of money. So, you know, what kind of prompted you to sort of you know, write that chapter, Nick?
I think because a lot of people talk about money, we obsess over money a lot. I mean, in at least in American culture, and I think like I'm started to realize that like, you know, money, don't get me wrong, it matters in certain cases. If you need money to survive, like that's it, it's much more important than your time, right? There's
Yeah.
certain people where that's not true, but I think as you start to, you know, build some wealth and all that, then you start to realize like really time is your most important asset and how you use it. Because obviously you can trade time for money, but at some point you're not going to be able to anymore, right? At some point, you know, all the money, you can't trade it the other way, right? You know, you can trade it a little bit, you know, at least midlife. You can say, hey, you know, I don't want to do my laundry every week and spend 2 hours. I'll just pay someone to pick it up, deliver, you know, clean it, bring it back, deliver, all that stuff, right? And you can pay, you know, let's say $15 a week to do that. You are giving up some of your time and earning that, but now you maybe get 2 hours. So let's say it took you like half an hour to produce that $15, but you now get, you know, you save 2 hours of laundry time or whatever, right? So that's the type of thing where it's just, you know, things like that where you can kind of buy your time back in small ways. But really, as you get much older, you can't anymore, right? You can't just say, hey, I want to just live forever. Like there's no amount of money that'll do that, unfortunately. So that's just the thing to keep in mind. And really on top of that, which I didn't really get into as much in the book, is just like your attention. Like on top of your time, like you have a lot of people have tons of time and they just don't know how to use it properly, right? And they just their attention's being pulled away by TikTok and Instagram and everything out there. And don't get me wrong, like I get pulled into Twitter and Instagram sometimes too. I'll be as guilty as anyone else, but you know, it's about limiting that stuff and making sure you can like still do something like productive. Like I feel like I'm still being productive, so I give myself freedom to like go down a Twitter rabbit hole every so often, right? So I have no qualms about that. And I don't think you should feel guilty about that. But if you don't, you know, if you're not trying to build anything that you care about and you're in a job you don't like, then you know what, there's you kind of isn't an excuse, right? That's
Yeah.
my counter, right? If you're enjoying what you're doing and everything's great, do whatever, like watch TV, watch Instagram and stuff, but you can't be sitting there complaining about your whole life and then what do you do in your free time to change it? Nothing. And it's like it's really tough, you know. So that's my counter.
Yeah, and what I would add to that too is like, you know, what you wasting time is when you're doing something else other than you intended to. So like, if my intention on Friday night and Saturday night, or, whenever I kind of choose to, do something where I'm like not working, that's my choice. So I'm not wasting time then. I'm doing something with my time that I value and that I want to do. But if you, have a certain goal, and then, all your free time is not chasing that goal, then like obviously, you're not utilizing that time correctly, and then you are wasting time. So like if you set to do something and then you start doing something else, then that to me is wasted time. But if have, if you have 30 minutes a day or an hour a day where you say, okay, I just want to, do whatever it is, go down a rabbit hole on Twitter, or watch TikTok videos, or do something that I know is going to be, mindless and not really going to, produce anything, that's okay, as long as you kind of set that time aside, and you have the time that you do need to accomplish the things that you do need to get done. So Nick, we're totally out of time. I feel like I could talk to you forever here, but is there anything else that we didn't cover that you want to mention?
Oh, no. Yeah, I think it's been a great combo. Appreciate you
Okay.
having me on.
Awesome. And so again, guys, this is the book here. It's Just Keep Buying. Hope you guys, get it. It's unbelievable book. Very, very easy read too. You don't have to, be like an economic guru to read it. And it doesn't matter where you are, I think, in your financial life. It'll definitely help you out. So Nick, just tell people where they can find you on Twitter, Instagram, and all that kind of stuff.
Dollars and Data. That's on Twitter, just all lowercase dollars and data. Instagram, my name is Nick Maggiulli. It's probably be in the show notes, just how to spell that. But yeah, that's where you can find me. My blog's dollarsandData.com. So, and thank you, everyone. Thank you for your time.
Okay, Nick, thanks so much. And everyone, thanks so much for listening. And as always, I'll be back again next week.